In part 1 of the video, we explored Warren Buffett's significant move of investing in Japanese companies using yen, signaling his concerns about the US dollar's strength and the nation's fiscal policies. Drawing parallels to his 2003 strategy, Buffett's actions suggest a potential prolonged decline in the dollar, reminiscent of the previous lost decade for US stocks. In part 2, we delve deeper into Buffett's playbook, his latest warnings, and what they mean for the investors and future of market. Buffett isn't just worried about the amount of debt the US has, he's also concerned about who holds that debt.
Because it's like the old saying, if I owe the bank $1,000, that's my problem. If I owe the bank $1 billion, that's the bank's problem. And right now, the US is like that bank. And in this case, that might not be such a safe position. Here's a chart that shows how much of the country's debt is owned domestically in the US versus internationally. The larger top section shows that most of the new debt we've been accumulating is owned by a combination of US corporations, hedge funds, and citizens, while foreign ownership has stayed fairly steady for now. This might seem like a reassuring sign. I mean, isn't it good that the US government is mostly in debt to its own citizens? But with the compounding growth rates we talked about earlier, investors are worried about just how much debt US investors can absorb before foreign investors have to pick up the slack. Think of US debt buyers like a balloon. You can only stuff so much money into it and stretch it so far before the pressure forces money to go out into the rest of the world. And that's the risk. Once foreign investors start to accumulate more and more of US debt, will they allow the US to keep borrowing new debt just to cover the old debt indefinitely? Because that's exactly what the projections say is coming. This brings us to some interesting parallels between Buffett's 2003 predictions and his move into Japanese stocks today. Back in 2003, Buffett was focused on the US trade deficit and how it gave other countries outsized influence over the dollar. But today, the situation is almost flipped. Now, the biggest shareholders of US debt are also the country's biggest trading partners, Asia and Europe. But 3 countries stand out as owning large chunks of US debt. The UK, $55 billion, a longtime economic partner. China, $867 billion, an economic partner and a rival on the world stage. Japan, $1.1 trillion, the largest foreign holder of US debt. But wait, where have we seen Japan before? Oh, right, Japan, where Warren Buffett just invested $23 billion of Berkshire Hathaway's money, while at the same time selling a bunch of US stocks. What does it all mean? So what does it mean when the same country Buffett is buying into is also the biggest holder of US debt? Well, it isn't some grand conspiracy theory, but it's also not nothing. Japan has relatively low inflation, solid industrial companies, and a currency that's historically been seen as a safe haven, especially in uncertain times. But the US also needs countries like Japan to continue buying its debt. If foreign investors decide the US looks too risky or demand higher interest rates, things could go downhill fast. Buffett warned about this worst-case scenario back in 2003, saying, an abrupt shutoff in credit, like many profligate overspending nations have suffered in recent decades, would devastate the country economically. So Buffett shifting money into Japan, just as the US becomes more reliant on foreign capital. It's not just diversification, it's insurance, in case global trust in the dollar begins to slip. Right now, we just have a bunch of people accumulating US debt. But some analysts think Buffett sees a potential catalyst that could ignite the whole thing: tariffs. Now, this is a nuanced topic, but having a basic understanding can help us make smarter investing decisions. So here's what matters for investors watching Buffett's playbook. Tariffs can, in theory, help reduce the US trade deficit and thus boost the strength of the dollar. In fact, back in 2003, Buffett himself proposed a tariff, by another name, as a way to restore trade balance. But that's only if tariffs are done carefully, without spooking foreign investors. And that's exactly what some experts think is not happening. Buffett himself recently claimed that tariffs are an act of war to some degree, and Deutsche Bank warned in 2025 that the dollar's safe haven properties are being eroded and its reserve currency status is at least somewhat in question. Tariffs might not be the thing that triggers a flight in foreign capital, but the conditions are now set up so that if the wrong thing happens at the wrong time, things could go south very quickly. And this time, it wouldn't just lead to a weaker dollar or a lost decade in stocks. It could trigger an inflation shock, a funding crisis, or even a major market correction. The phrase is overused, but this really is like a ticking time bomb at the center of the U.S. economy. But this isn't about panic. This is about preparing. Buffett is still optimistic about America's long-term future. But you don't become a centibillionaire by just hoping for the best. He's taking steps now to protect Berkshire in case the U.S. doesn't change course. And even if the worst case doesn't play out, these moves can still pay off for investors. So what is Buffett's playbook? And what smart steps can we take as investors to protect ourselves? Buffett might be buying Japanese stocks, but most investors can still get international exposure without holding billions in yen. Passively investing in a broad U.S. index fund is great to make up the core of your portfolio. Buying ETFs like Vanguard, Schwab, Fidelity all give strong exposure to the U.S. market. But if we want to follow Buffett's example, we should look internationally as well. A 2010 study by Kritzman and colleagues found that international stocks don't always move in sync with U.S. stocks, and that opens the door to higher returns with less risk. Multiple studies over decades confirm international diversification lowers volatility. An easy way to do this? Pair your U.S. holdings with an international ETF. Some solid options include VXUS, Schwab, Fidelity. It's not about abandoning U.S. stocks. It's about not putting all your eggs in one basket. Buffett is currently sitting on over $300 billion in cash, mostly in short-term U.S. treasuries. But he's not doing that out of fear. He's doing it to stay flexible. As he once said, we will make our best deals when most people are pessimistic. So hold cash for when those deals appear, because eventually they always do. Buffett has lasted more than 60 years at the head of Berkshire Hathaway by staying balanced and following the data. If we look at his portfolio today, he's still mostly invested in solid U.S. companies. So while it's important to be informed, it's more important not to panic. Buffett isn't selling everything. He's just taking small, careful steps to hedge risk. And that's exactly what we should do too. Yes, we'll absolutely see market crashes in our lifetimes, but don't let fear dictate your strategy. The strategy that's worked for Buffett through wars, inflation, bubbles, and crashes has been simple. Discipline, regular investing, long-term thinking, avoiding panic. I realized while making this video that Buffett has been investing my entire life, and likely yours too. If this really is his final shareholder meeting, then it feels almost like a final message. Stay informed, stay invested, and follow the data, not emotion. It may be the end of an era, but the lessons will last forever.